Good afternoon, everybody. Thank you for joining. Robin, I'm going to let you kick it off.
Great. Yes.
Okay.
Thank you guys for taking this time out. We know everybody has busy schedules, so thank you for stopping for a moment to go over our new class here for Club Capital.
Classes in session.
That's right. There you go. Yeah. So yes, today we're going to be going over Preferred Equity 101, just kind of opening up a lot of discussion in this arena. Obviously, we have some opportunities kind of tracking this direction. So that's why we felt like this was a good topic to tackle today. So yes, just to introduce myself, I'm Robin Massey, Director of Investor Relations with Club Capital. So I'm thrilled to be the host today, but our main event here is going to be Darin, which I will intro in just a second. Let me get all of the other stuff out of the way real quick. This is for educational purposes only, so we're glad that you guys are joining us. If we do have information today on an opportunity, please know that it is under regulation of SEC 506C, so we're just covering all of our bases there. So done with all of that stuff. The other thing is that we are recording. So if anybody does have to jump off, do not fear, we will have that recording out later this week. So, all right, enough about that. Moving on. So for our industry expert today, he has over 2 decades of experience in the private equity world, mainly focused on multifamily assets. Let's see, he's overseen projects exceeding $1 billion. Wow. Totally not here.
I'm old.
And navigating multiple market shifts. Obviously, it is our principal here, Darin Davis of Club Capital. So I'll hand it over to you.
Thank you very much, Robin.
Yeah.
Appreciate that. So good afternoon, everybody. I'm really glad you're joining us. And if you pick this up at a recording later, I would encourage you to go back and watch it again. If you are not really familiar with preferred equity, it is a little different. And it's one of those where common equity, which we're used to, kind of ruled the roost for the last 12 to 15 years, but the markets have changed.
Yeah.
The debt markets have changed. A lot of things have changed in the world of commercial real estate. And when one thing changes, it's kind of like a positive and a negative. Something else has to open up. And preferred equity is what the opportunity is that has opened up to this market for us. And so being a very aware and nimble group, we've actually decided to seize on that. I think we made the decision about a year ago to really look at preferred equity. So guys, what I'm going to do is I'm going to spend, you're going to get really 3 things out of this. We're going to talk a little bit about demographics and data. You're going to think I'm doing some type of research paper in the first 10 minutes here, but I think it's really, really important to understand what's driving the market today and what's driving the market, I think, over the next 2 or 3 years. Then we're going to look at pref equity as to why and how, or what is pref equity and how does it benefit both the developer and the multifamily and the investor. So, and then I think towards the end, we're going to go into what an opportunity looks like and how we would execute on that, because I know over the course of the next 24 to 36 months, pref equity will be a part of our offerings. Not that we're getting away from common equity, but today it doesn't pencil. And you'll see some of the facts and the numbers on that as we move into it. And again, I want to reiterate what Robin said about, we're not giving investment advice, tax advice, legal advice. This is truly just our experiences. And what we're presenting today is what we live every day from experience. We do it. So let's move on. So let's talk about, kind of the state of the market. So really going to be focused around population growth, demographics, migration, jobs, business relocations, and that's what we're going to focus in on. I want you to look at this from the U.S. Census Bureau. If you look to the legend to the left where it says percent change, and you see 1% or more, that's not a lot. Okay, you think 1% is not a lot. Well, we are not creating more babies. Okay, this is not population growth. Okay, that's doing this. This is migration. Okay, and what this is migration primarily of, this is migrating from one state to another. Okay, it could be from a blue state to a red to a blue, but there is a big migration changes going on right now. And if you look at the 2 states we're going to focus in on, it's going to be Texas and Florida, and both of those are dark green. And there's a reason why we're focusing on those two states, not one because we live in Texas, but there's going to be a lot of data behind what we're going to talk about today is why we're focusing there. But migration is a big one, people. One thing I want to point out here, if you look at the population growth of the top 10 cities, top 10 states, you look at Texas, Florida, the Carolinas, Georgia, Arizona, Virginia, Colorado, Utah, Texas and Florida represent 58% of the net migration. And those two states alone control more than half of the net migration of the top 10 cities. That's significant. You know, and not only are people migrating here, but businesses are too.
They're bringing this people.
They're helping the whole migration component. That's, I mean, it's a, you know, they feed off of each other. You know, looking at just the state of Texas, and we'll focus on Texas quite a bit today versus Florida because we do most of our business in Texas. But if you look at the DFW area alone, this isn't Austin, Houston, San Antonio, but just in the Dallas-Fort Worth area, you have 24 of the Fortune 55 in that metro area. And, you know, Texas having, you know, more than 10% of the Fortune 500 is fairly significant. No other company has that percentage or that number of headquarters in their state.
Yeah.
2023 we saw 17 companies. You may recognize a few of these. You know, I think some of the bigger ones in there are Fisher Investments that we've seen. Also the Strategic Armory Corps. The other one that I thought was an interesting one was the M2M certified. So, but looking at 17 in just 2023 and kind of a down market, just goes to show why companies are moving here. And it's really for the business and economic climates. Here's just a quick list. I'll spend just a second on this. You can see in 2020 over to the far right, some of the more notable names were Hewlett Packard, Oracle. You know, in 2021, Tesla moved here to Austin, which changed the landscape here quite a bit. A lot of other companies moved here and continue to do so. And again, you can see that we had 38 relocations in 17 and 23, which we mentioned earlier. What that means is jobs. Okay, jobs. But the other thing that I want to talk about is you look at jobs. We talked about Texas and Florida for the migration, and you look at Texas for the companies relocating here. If you look for job creation, Texas #1, California #2, Florida #3. Yeah. So again, we're producing jobs. We're an economic climate. We're bringing companies in, and there's a lot of reasons, you know, that people migrate here. It could be for tax reasons, quality of life, affordability, weather. I mean, there's a dozen different reasons, but
and this is data from 2023.
Yeah, this is current.
This is up to date.
Yeah,
this is current.
This is in the past, you know, 3 months. This was the final data numbers that came out. And one more pat on the back here. We'll talk a little bit again about Texas. But if you look at over the last 5 years, and this isn't just a one-off deal for 2023, over the past 5 years, the Dallas, North Texas, Dallas Metro was #1 in job creation. Houston #3, Austin Round Rock where we live #4, and at #9 was the Fort Worth location. So if you look at Dallas, Fort Worth, the DFW, that's just massive in the jobs that they brought in. You know, so we have 4 of the top 10 for job creation, representing 45% of the job gain.
Yeah.
We kind of got a little bit of a juggernaut here. Yeah. Now, what does all this mean? Well, we're going to start transitioning into kind of the pref equity and the demand and supply demand for housing. And we'll obviously be talking about multifamily. But this is something that caught my attention. I saw this graphic a little over a year ago and started following this. You know, what's driving other than the obvious with jobs, what's driving the demand for housing and multifamily? That's what we track all the time. And if you look at just the state of Texas, and it's different in bigger metros, but this is just overall in the state of Texas. The average rent in the state of Texas for an apartment is $1,380. The average cost to own a home just for the mortgage is $2,195. Well, if you look at that delta, that is $800 more a month to have a home on a monthly payment versus an apartment.
That's significant.
Very significant.
That's just the base. What else is on top of that?
Well, and that's a good question, because that doesn't account for taxes, insurance, maintenance, and the 20% down you need to buy a home. If the average price is, say 400 grand, you've got to put 20% down. That's an 80 grand check. How many 25, 30, 35-year-olds can put an $80,000 deposit down and hit that number and hit all the ancillary numbers to just live in a home? So the point being here, guys, is that I'm a firm believer that we are, and you've heard this from other people far smarter than me. We are becoming, if we're not already, a renter nation. And what does that mean to us? Multifamily. That's the affordability component. The BlackRocks of the world are going to make sure that we stay in this environment for an extended period of time, if not for a long, long period of time.
Transition out of all of the data dump.
Yeah.
Thank you for doing that. Very important that we have that information, but let's open it up to what is the opportune time for an investor right now. Like, dig into that a little bit.
Yeah, I want to, bingo. You hit,
sorry.
No, you hit the mother load right here. Okay. So, and this is, we're going to talk around this. What's really happening in the market today? And this is primarily with loans that were taken out 2 years ago, maybe 3 years ago, when interest rates were 3.5%, but they were done on a floating rate. All right. So if a developer said, hey, I've got a $40 million construction loan, we're going to pay, I did the underwriting at 3.5% on my interest for that 40 million. I've got my interest reserves to pay for that interest over the construction period and the lease up period. I'm good. Well, here's what's happened. That floating rate started at 3.5. That floating rate is now 8.5%. And when you have a 2x in your increase in your interest rate, and you've got 25, 35, 40 million sitting up there, that cost can get significant.
Right? Those reserves are gone.
And why we circled this here is because if you look at 24, 25, and 26, you are looking at $600+ billion of loans maturing. Okay. Now, what is that going to do? That's going to create an opportunity, and we'll get into that here in a second. But that's where the pref equity component is going to come into play.
Ready for the next one?
Let's do it. So, don't know how many of you firsthand experienced 2007, 8, 9, the financial crisis, but we did. And there's a couple lessons here. And this chart is more on construction starts, what I'm going to talk about here in just a second. But it's going to dovetail into exactly the point I'm going to bring up. In 2007, 8, and 9, you can see construction starts went way down, right? Well, what happened is migration didn't really change in Texas. People were still moving here, but product was not being built for about a 3-year period. And what happened is when the recovery started and there was a gap of virtually no construction for 3 years, but the migration kept coming, the demand for housing just skyrocketed. And you can see that's the hockey stick effect. I mean, there's a couple downturns, but over that 10, 12-year period, there were fortunes made. Okay. Now, I was actively involved in commercial real estate. I had not gone through a correction this deep. So I was kind of sitting there a little gun shy. And what I didn't do is capitalize on that upside as much as I could have. Right. Well, let's look to the right of the screen here. Look to the right of the chart. You have virtually the same thing starting to happen. We are probably going to hit the bottom, I think, 25, 26, where the supply is just not going to be there. Construction starts, as we say, you can see the starts just right here in Texas. They've fallen off the cliff. And people are still moving here. Yeah. You saw in that very first chart, we had a 1% growth in Texas last year. Okay, that's going to happen again this year and the next year and the next. And they're moving to cities like Austin and Dallas and Houston and San Antonio for jobs, for quality of life, affordability, just a lot of economic and personal reasons. But what's happening here is that this opportunity is going to start showing up here this year, next year, and the next. And I think, again, we're going to see that hockey stick effect and in the supply and demand. So, and what we're doing, and we'll get into this just a second, we talk specifically more about the pref equity. What we're doing is positioning ourselves to be able to capitalize on that over the course of the next 36 months. Similar chart. I want to drill down just a little bit more on the Austin market here because we are directly in this market. We do all of Texas and Florida. But you can see here, this is just so significant, the drop here, that you can see the multifamily starts. We had, almost 35,000 units in 22. You have literally cut that by 60%, 65%. And 24 is going to be less. 25 is going to be same or less. But then here comes 26, 27. Really kind of the last thing we're going to talk about on kind of supply, demand, and housing before we get into the exact pref equity component here. If you look at this is 2023 numbers, okay, the South, which includes Texas and Florida, you can still see that the orange bar far exceeds the black bar. Well, the orange is demand and the black is supply. So we still, at the end of 23, had more demand than we had supply. Now, I think that's going to even out over 24, 25, and 26, but it's not going to flip where we have more supply than demand. These numbers will change slightly, but we're in a really good position because we need to absorb that over the next 2 or 3 years, and that will get absorbed. And then we're going to go, oops, we don't have any more supply. And then that's when the rocket ship takes off.
Well, one thing that I know is very important to our investors is the safety and security, which is what we've been listening to, what we have heard. So can you dive into with preferred equity, like how and why is this part of?
Yeah, and I think we heard from our investors, hey, this is kind of a crazy market. You guys have done common equity. And we would tell them, we'd say, we haven't done anything in a year and a half on the common equity.
Right.
It just didn't pencil out. We couldn't make it work. So we also heard from developers, hey, we need some relief here. Can you help us raise equity for preferred equity then, if not common? And we absolutely said, yeah, because what's happening is our investors are saying, hey, we want something that's more sure, a little safer, and really simple. Okay, I don't give me some hocus pocus stuff that's gonna make me rich because we won't do it. So this is just basic blocking and tackling. And I'll spend a couple minutes on this, but if you look over in 2021, and we talked a little bit about this earlier, but I want to reinforce a couple things here. Pre-22, pre-interest rate hikes, leverage issues, all of that, very straightforward structure. Senior debt, which is your bank loan for your construction or acquisition, and then your equity came in for your value add or your construction, whatever. Really simple stuff. Typically 75% debt, 25% common equity. Well, so 2023 hits the perfect storm. Actually last year, 2022, but here we are in 23, and I think this is going to be fairly realistic for another, like I said, 2-3 years. Banks started going, you know what? We're going to ratchet it back a little bit. So instead of providing you 75% of the debt, we're going to pull it back to 60. Okay, so the developer's going, all right, what do I do then? Well, the common equity is typically the most expensive on that. And what the common equity is looking for is a really strong multiple and really a good IRR. But these things didn't pencil out. I mean, you literally had the perfect storm. You had interest rates going up. You had your leverage, your debt going down, like we're showing here, and then which brought down the value. So when the value goes down, the leverage goes down, and you even get a bigger spread. So in comes pref equity. So what's happening here is that you're looking for what you probably may have heard, rescue capital. All right. So what the developer's saying is that, hey, we will take a sliver of pref equity and put that in the capital stack, right behind the senior debt. And like it says preferred, you are preferred over the common equity. So you'll get your investment back plus your return before the common equity gets their investment and their return. Mm-hmm. So that is a nice, safe position. And the nice thing about it, it's a defined timeline and it's a defined term. So it's 2 years, 3 years, 4 years, and it's 10%, 11%, 12%, whatever it may be. So you as an investor and the developer know exactly my cost of capital. So, I want to point out one thing here. This is pretty important. I mean, it is important to understand this. I had a friend of mine ask me, should I do this deal with this common equity? It looks great, and I said, well, what's the returns, and let's make sure it all works out. And we kind of looked at it. I said, you know what? I go, you're putting in money on a Class A project, and granted, great location, great city, great demographics. The IRR, or the projected return, was 12%. Okay. And I said, well, okay, what if something goes wrong? What if it's off and it's 10% or 8% or 6%? Okay. And we talked about it, and I said, what are you really trying to accomplish? And he said, well, I want to get that. I'm trying to get 10% return. Okay. I'm trying to get 10% return. And I said, well, why would you go into a common equity that I don't think really pencils today? Okay. Because I don't think this market is finished flushing out a lot of stuff. But and I said, why wouldn't you go into a preferred equity where you're assured 10, 11, 12%? Now you don't get that upside, but I don't think the upside's there today.
But you have that priority position.
You got that priority position. He kind of looked at me and he said, you know what? Because that's a lot of risk to maybe get that up to 12, 14, 16. I said, yeah, it really is. And he said, how long are these preferred equity deals going to be around? I said, look, for the developer, they're not optimal, but that's the option they have today. So I think 2, 3, 4 years, like we showed that $600 billion in debt, I think that's the window. And we'll talk a little bit more about why that window is even more important than just investing in a fixed rate of return. I got to bring this up one more time.
There's your window.
Yeah, this is my chart right here. 600 billion. Okay. And I mentioned this. I don't think interest rates are going to significantly change this year. I think there will be some relief next year, some. Okay, but if you think we're going back down to 3%, 3.5% anytime in the next 3 years, I don't see it. Okay, I just don't see it happening on that. But I think that this opportunity and those interest rates are going to stay high. I think values are going to be floating lower. And I think the leverage is not going to get back up to 75% anytime soon. I think it's still going to be, lower, which is causing, which is creating this opportunity for us. So let's look at kind of how this looks on math. All right. And I think this is another important thing to understand. When you look at the capital stack for cost, right? So let's say we have 100% of cost. The target for us is that we don't want to have our position plus the senior debt go much higher than 80%. Okay, maybe 85 if there's some special circumstances, but I think that 75 range is what we're really comfortable with. Okay, and this is a real world example, right? So if you look at this one that we're looking at today, and I think this is right down the fairway, I could see us in that 75 to 80 range on almost all of these. But what's important to understand here is that at $65 or $66 million, you're looking at the senior debt and the preferred equity. So that's the bank and us, the lender and us, representing 76% of the capital stack. And then behind us is that common equity. So that fits right into our wheelhouse on the numbers and the math. Not only do we like the asset, and I'll tell you a little bit more about that, but this is really a fairway shot of what we're looking at on the numbers.
Now, are you ready?
I'm ready.
All right, the how and the why. Let's sum it all up.
Let's wrap this up. So, like I said, this opportunity is really, I think 2 to 3 years, but it's not just a one and done. Not only do we have a pipeline that you'll be able to do, 3, 4, 5, 6 of these over the next couple of years, but what we're doing is we're providing 2 solutions. All right, the developers that we're working with, that we're focusing on, are quality sponsors. They've been around for a while. They're not just one-off mom and pops at all. Like one of the guys we're working with has 27 projects. Another group has 7 projects. Another one has about 14 or 15. Those are the 3 primaries that we're working with. So there's opportunity and there's tenure and there's experience and everything, but we're providing them a solution, and they're going to be around. They're not going anywhere. They've been in business for, one of them 30 years, 35 years, another one 31 years. So there's these are seasoned developers. But just like everybody else, that interest rate gap in values causes for everybody, right? But it's also providing a solution for our investors, because tell us what you heard for the last 3 years from investors. What were some of the top things you heard? You talk to them all day, every day.
Well, yeah, I mean, I think that's why preferred equity is really hitting that niche that they're looking for. I mean, you have a defined term that, you have the safety and security in. You also have a shorter timeline, which, some people don't want to have to either, wait for that money to come back to them. Another thing is immediate cash flow. That's the huge one. That's what we always heard.
That's what you came banging the door.
A lot of our
cash
projects
flow.
in the past have been development, so there wasn't cash flow. We were building the project out. So with this opportunity, we actually have that you could get cash flow from day one on that first quarter. So
I mean, and we heard kind of that, like the slide we did earlier on the intro, kind of safe, secure, simple, and I want cash flow. And so this is providing a solution for our investors, which could parlay into more, but that's the thing we heard. And that's why we wanted to do this. But a couple of things I want to point out is every asset that we are going to provide or consider to provide preferred equity, we're going to underwrite it like we own it. Okay. Just like we were going to go out and buy it. What we do not want to do is get into a project where we do the preferred equity and it's not in a market that we like. It's not in a demographic that we like. It's not the type of asset that we understand. It's not the city. I mean, everything. So just like we were going to own it, we're going to underwrite it like that. So we're going to do the same due diligence as if we were going to buy this asset, even though we're not. But what that means, and I'll share with that in a second, is that there could be other opportunities. So the other thing we talked about the kind of the safer double-digit returns, that was a key requirement from our investors. Get us in that kind of safe, secure, simple. We don't need a whole new product set or a whole new investment strategy. If we can fill a gap or plug a hole and do well, then let's go do it. And this is where it gets interesting. Okay, this is where it gets interesting. Think about this. The guys that we're working with, the developers, they're called merchant builders. Their whole business model is to build it, lease it up, sell it, because where they make the lion's share of their money is the developer fee, the GC fee, okay, and then with excellent performance, they get a sponsor fee, but that is all at the very back end. All that other money is front loaded, so they want to turn that money every 4 years. Okay, so these guys are sitting here going, gosh, the last thing I want to do is hold this asset for 5, 6, 7, 8 years, because their business model doesn't support that. They need to turn that money every 4 years. So what's happening here is that we're going to be in the group, the investment group. We will be able to see that asset's performance, property management. We'll see all the good, we'll see all the bad, we'll know the underwriting. So we'll have the ability to have a chance to actually acquire that asset, because we are not merchant builders. We are cash flow guys. So we want to buy it, improve it, cash flow it, and hold it for a period of time, and then either refi it and pull cash out and then continue to cash flow it, or possibly exit at just a crazy number, because we're not going to walk away from money if it's crazy good. But the goal is to have a front row seat and understand that asset actually before the thing goes to market, which ties into potential acquisition. Now, are we acquiring all of these? No, but are we in the right spot to acquire them? I'd much rather be sitting at number 4 on the front row and getting paid to sit on the front row,
yes,
and have an opportunity to buy the asset, than being somebody on the outside trying to figure it all out coming in later.
yes, very beneficial.
So this I wanted to put this one up because I think this is just such a clear picture of what pref equity is and what it can do. Now let's talk about worst case scenario, okay, which would not be worst case scenario for us. However, there's a bunch of ancillary issues or items or things to consider. But if you look at a traditional common equity structure over on the left side, okay, in a deal that we're about to announce here fairly soon, if we haven't already, you can see the common equity, and this is the fairway shot I did earlier, okay? You can see the common equity, the preferred equity, and the senior debt. And the thing that I want to point out here is that the cost for this 264 units averages $250,000 a door, okay? That's about what it costs today to build a multifamily complex with 200 plus units per door in a Class A environment. But let's look at the pref equity. Let's hypothetically say that the sponsor was not able to perform, or the clock had run out on them, and they did not have a way to exit their loan and get permanent financing. The way that we're structuring these is that we could, not that we're doing this, we're not a loan to own shop. We're saying we'll own it in the event something doesn't work out. And that's why I talked about our underwriting and locations and demographics and all that. But if we were to pick this asset up, we could, in theory, wipe out I hate to use wipe out, the common equity may have to forego their funds. Okay. So if you look at the cost now, should we were to acquire this asset in some type of default scenario, we would be picking up a Class A asset at $189,000 a door. So there's two things I want to point out here. The safety between 189 and 250 on a cost, okay, and then the basis that you would be picking up this asset at 189 and not 250. So if you look at long term, what my basis is going forward, it's much lower. And then if you look at the difference between those two, that kind of safety, it kind of speaks for itself. So what does this look like for an investor? Why don't you take this one?
Oh, well, the preferred equity, we have that immediate cash flow. Now, the way it is separated is that you have your current pay, which will get paid out each quarter. And then the deferred pay will get paid out when we exit. So you see that at the top. It is the 12.5% annual return split up into that 7.5 and 5%.
Here's the great thing, the current pay, I mean, you're making $7,500 a year paid quarterly.
Yep.
Okay. And then we're deferring that 5% at exit. But the term on this one is, I think, right at 3 years. It may be 3.2 or 3.1 years, because we are coterminous. And let me point this out. We are coterminous with the senior debt. So if the senior debt, it either refis, sells, expires, whatever happens, we get paid at that time. So it's not like we get paid. Well, I mean, we could. I doubt the developer would come in and pay us off, early, but they sure could. But we have a minimum 2-year return here. But when the senior debt terminates, we terminate as well. So, and again, I think that's 3 years and a month or something like that. But that just ensures that we're getting paid at the time of a sale or recapitalization or something like that.
Now, we do have just want to point out these redemption and penalty mechanisms that we also have in place. We can discuss those later.
Yeah,
there are just some safeguards
Yeah.
On the back end for us as well.
There's some monetary things here and some financial penalties, because what we don't want to do is just be such a this loan to own thing that I mentioned. I mean, that's not the goal here. These guys, this equity came into a deal, we're rescue equity. We're not shark equity or pref equity. So, there's a couple of, periods of time, whether it's 30 days, 60 days, 90 days, that, the borrower could extend it, but it's not infinite. Okay. But there are some penalties in there, which, and everybody understands that, but we don't really think this asset would go into that, but there are some safety measures for that as well.
Speaking of the asset, I think that's our next thing. Here's a nice little rendering of it. Did you want to talk just real quickly about where it's located?
Yeah, listen, I mean, for you guys that are in Texas, the DFW area, and I-35 runs north and south. Denton, Texas is a suburb of the DFW area where 35W, which runs right up through Fort Worth, and then 35E runs right through the middle of Dallas, and they converge at Denton. So, you know, the convergence of that, and from a transportation, from a growth, you have easy access to Fort Worth, easy access to Dallas, two major universities. They've had 3 or 4 really nice relocations of corporate relocations there. I think if I recall, in the last 10 years, they're in the top 3 or 4 in growth. Population growth. Yeah, I know they've just exploded on that. So we couldn't. This is one of those loan to own things. If we do own it, we underwrote it like we would own it. I would, if this asset came back to us, I'd figure out how to do a backflip. I don't know if I could, but I'll try to figure it out. So,
well, anybody, if you want to scan that QR code, that will actually take you directly to a lot more information about this asset. So go ahead and click that, and always just reach out to us too if you have any questions. All right. Well, let's talk about Club Cap real quick. Yeah. If you want to go into that.
And for you guys that know us, you know that we did a name change and a rebranding 3 months ago. And what I will tell you this is a different type of asset. Okay, so the returns you're seeing up there are when we're doing our development, and we were following the merchant builders kind of business model. So we were in them, we got great returns, you know, but we didn't have cash flow, you know.
Right.
And the returns are fantastic. You know, if you look at equity, right? Yeah, it's common equity at 2.6 multiple. Nobody's going to complain about that. Yeah, but it's different. Okay, I really don't see us doing a lot of common equity anytime soon. Now there's going to be that, you know, that unicorn opportunity where we say, hey, you know, and we'll figure that out, you know. But what you're going to see going forward is more of a cash flow versus multiple. So we're not going to walk away from this because there are some good opportunities. But I think for the next 2 or 3 years, you know, the returns are going to be really consistent in that 10, 11, 12% annualized return paid quarterly. So the cash flow coming up. So there'll be a little bit of difference there. So that's the main thing I wanted to point out. You know, that 2.6 multiple, that was in that decade where you could almost do no wrong, right? Everybody, but you know, I guess there's not near as many syndication groups and private equity groups today, yes, as there were 5 years ago. Yeah, yeah. So, yes. But you will see we'll be adding some numbers in here on the cash flow, which I'm excited about because we've always wanted to do cash flow, and it's been asked of us, but it just we couldn't. I almost want to say fit it in, but now we will. We are.
Yes. Well, I think a lot of our investors, you know, they know what's going on there. They have their own pulse on what's happening. And so I think a lot of them have readjusted their expectations and understand that the market is just different right now. Yeah. So,
well, and I think we're at the end, but I want to wrap this up. I know I kind of beat my chest about Texas, born and raised here, blah, 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 all that stuff. But I do quite a bit of travel, and I literally have people when I say I'm from Texas, they just turn around and focus, say, hey, what's it like? I've never been there. I want to move there. Or
do you ride a horse?
A horse, yeah. No, I'm serious. I'm serious. I still think John Wayne. But it's we have a great business climate. You know, we have a great everything. I mean, I could go down the list of the things that I'm just very proud of what we do here. I mean, quality of living, schools, businesses relocating here, very diverse, very, very diversified community. If you had looked at where we live in Austin, I first started coming here in high school in the late 80s, late 70s, early 80s. It was a hippie town. I mean, it was hippies. Today, the hippies are almost gone because there's just been such a wide, diverse group of people, from education to government to technology. I mean, everything has moved here in the last 20, 25 years. And it's an exciting time. And quite frankly, Texas is not slowing down, nor is Florida. Yeah, they're gonna cruise right along.
I think we're up to our Q&A for anybody that is still with us. Let's open up that. Please feel free, if you guys can open up the chat or the Q&A bubble and go ahead and type in any questions that you have. Obviously, specific to preferred equity would be great, but we're open to anything else. If you have any questions, there's a lot going on, and we're happy to answer anything that you have.
I know this is a good one. Okay. Can you speak to the payments aren't made if the asset's not performing? So let's talk about how that's done. There's a couple things that are happening here. One is, if the asset is performing and is cash flowing, our money is being distributed to us first. Okay. But if it's not performing, what we've done is we've set up a reserved escrow account to handle just that. So the developer that's borrowing the money from us, or that we're making the investment in, agrees to put up certain monies in escrow, because if we're going through construction right now, there is no cash flow.
Right.
So if we're in the last 3 to 6 months of construction, or we're going through the first 3 to 6 months of lease up after we get the CO, there's not. But we negotiate up front monies to actually pay that return. Now, if the monies are not paid, we start securing positions of penalties, and those start coming in. And then if just for some reason we get to that 11th hour and the asset is not performing, I'm going to go back to the 250 a door and the 189 a door. We can end up taking the asset over at a deep discount, not distressed. I don't think we're going to see distressed assets here, but we're going to see deep discounted assets. So we're going to get paid. And the only way that I don't think we would get paid if Armageddon hit and everybody was in that situation. And it could happen, but I don't foresee that the way we're structuring these deals.
Yeah, the important thing is that escrowed amount. Like we do have that up front.
Yeah.
That safety.
Yeah, and that didn't cover everything. And we have capital in there too. But I mean, again, that common equity in the example we showed, I think it was, $20-something million. We're ahead of that.
Right.
So if we take the asset over, we take a discount of 20, 25, 30%, so sponsors not getting paid, common equity's not getting paid, and we're picking up the asset.
Yeah.
So, and if that happens, and our basis is something, 20% less, 25% less, and we get debt on it for that, where they maybe couldn't have gotten debt at 250 a door, but we can get debt at 189 a door. We'll rock and roll, especially in that hockey stick scenario that we were pointing out earlier.
So are Texas and Florida the only markets that we're looking at?
Great. It's a really good question. So I'll be real, by the way, of course I'm a homer for Texas. I also love Florida. They're not the only two that I think are going to be able to capitalize on the next 3 or 4 years. It's just, we're trying to stay laser focused. I mean, I love North Carolina. I love Georgia, Utah, Colorado, Tennessee. There are so many other kind of, we'll talk on you've heard people say the Sun Belt states, or, the South. I think the South and the Sun Belt states are going to do very well. We're going to stay focused in our backyard for the most part. That's good. So here's the question. Could you have pref equity and a part of the upside, kind of like common equity has? All right. So what that is called is participating pref equity. All right. So the answer quickly is yes. All right. And then it's a give and take, and it's a negotiation. You can negotiate with the developer for part of the promote, okay, which you could share with the investments. That could be your compensation as the sponsor on the pref equity, and however you negotiate that, you disclose that to your investors. But that can happen, and it will happen. And we very well could have one of those, any time now. But we wanted to negotiate the best return for our investors first, just straight up returns on the interest. Because sometimes, and it's not always, but sometimes there's some lending issues with that, on the loan. But anyway, yeah, the short answer is yes. We very much can see that.
Let's see, next question. What other asset classes or industry segments are you looking at to put preferred equity on?
That's good. So kind of as we said in the beginning, I mean, the debt markets, the valuations, you know, everything in interest rates, that's affecting commercial real estate across the board. And you probably hear, you know, offices kind of getting whacked right now. You know, multifamily is going to face some slow times, you know, but the other one that I really like, and the reason I like it is because of the safe, secure, you know, simple, is the triple net. And all triple net is that the way the deal is structured is that you get typically one tenant. There could be a few.
This is retail, right?
No, this would be industrial.
Oh,
Yeah,
industrial.
I'm not.
Sorry.
I'm not doing triple net
I
retail.
was like, whoa, hold on.
Sorry, this is industrial, and what I like about it is that you're dealing with credit tenants, brand names, and where we like it is up the I-35 corridor, because, you know, I think we all through the pandemic, we all heard about onshoring and offshoring, you know, everything from materials to drugs to whatever we couldn't get. We kind of learned a hard lesson that we didn't realize 70% of everything we consume is not produced in the US. So you've got this big onshore movement. Companies are bringing back in Laredo, Texas, which is down south, is I'm gonna call it a port, land port, is one of the, if not the largest port in the US today. And what's happening is that I-35 corridor all the way from South Texas all the way through San Antonio, where I-10 crosses it. I-10 goes east and west. I-35 goes north and south. And you're talking about a trucking mega lanes, you know, and distribution. So that I-35 corridor, I mean, primarily in Texas, but, you know, if you have triple net credit tenants and you know, in the industrial parks with new product, more onshoring coming on with production. I like the triple net because it's a set payment. It's immediate cash flow. You know, once interest rates start loosening up a little bit, 2, 3, 4 years from now, you know, and you do the refi, release up. But no, I'm not going to go into much more, but there would be one, there would be triple net industrial. That's one other industry, kind of the rest of them. And well, one more. I like hospitality. And in the workforce housing extended stay world. Yeah, that's my wheelhouse.
We got one of those on our
we do have one of those,
belt,
and I like the way it's performing right now. So
how often are distributions made? We touched on this just a little bit, but you can go back.
Yeah, so distributions in our model, I mean, sometimes they're done annually, semi-annually, monthly. We're going to start quarterly. Okay, so we will start Q1. I mean, 90 days, the first distribution we made, and every quarter thereafter. Yeah, so we will be doing all of ours quarterly. And then the last, let's see, do you want to read that one?
Sure. It says the fee or return structure for the private equity sponsor through origination, lending, management fees, and or is it more like a GP where you can also get an annual return?
So here's, and I'm going to kind of paraphrase, yeah, kind of what the fee is for us. So what we have, and it's disclosed in our OM, exactly what I'm going to share with you. We have an origination fee, okay, and we have an exit fee. And we also take the spread between what the borrower or the sponsor is paying us and what we're paying out to our investors. Yeah. So there is no, you know, and I think the question about the promote on the back end, I really want to start working on that. I mean, yes, these make for the investor and for us, you know, they're good revenue generators. But I've always been a part of the pay for performance. So, you know, if we can help this sponsor perform, I'd like a piece of that promote, you know, for our group on that. So, and that spread typically could be, you know, anywhere from 2.5% to 3.5%. So it'll vary deal by deal. And that origination, that exit it'll vary, but you could probably count on 1.5% in and 1 to 1.5% out.
Well, did you have anything else? We're kind of closing in on our time here. Anything else you wanted to hit?
I just want to say thank you guys. I'm really excited about where we are. I can't tell you enough. And that $600 billion debt that's maturing, that is going to drive so much opportunity. And if we can get into the Class A projects, going through stabilization and the surety of everything that we're doing is really buttoned up contractually, and we're in a really good position. And the other thing I really like about this, we're at that front row seat. We're gonna pick up an asset or two, guys. I mean, and we're gonna pick them up under replacement value. I know, and some of them can be far deeper than that, and that's exciting to me. And that's when I showed you kind of the hockey stick effect in 2007, 8, 9, and you see the drop off right now. I mean, we're in that trough right now, and I give it another 24 months, and that I think that hockey stick effect starts working, and that's why we're getting prepared for that.
The window of opportunity.
It is. Let's
Seize
capitalize on it.
Exactly.
I didn't do enough 12 years ago. I'm gonna do a lot now. So.
Yes. Well, thank you guys for joining us. We really do appreciate you taking your time out today. Please contact us at info@clubcap.co if you have any questions. That goes directly to me. Happy to answer anything. But yes, I think that's it for today.
Guys, thank you very much.
Thank you,
and,
guys.
and you know what? Call me directly anytime. This is a new investment class for us, but it's simple. It really is. But if you've got any more questions, please reach out to me directly. My email, the website has my phone number, everything. So it's out there.
Able to contact us.
Okay. Thank you.
Thank you.